Bring in Gabriela Santos of JP Morgan Asset Management, Kristina Hooper of Invesco. It's great to have you both with us. How are you assessing what this market's doing?
So I think as much as we've had a lot of headlines over the last 30 days, I think we're still in the environment where investors, CEOs, individuals are trying to assess the actual details around a variety of policy elements, around taxes, around government spending, as well as the flow of goods and talent. And so for now, we're really counting on the momentum that the economy and earnings had going into this year, which was a good one. We still expect around 2.5% growth, and we do think double-digit earnings growth is feasible this year, which is still a good environment for risk. But in terms of managing the decimal points of all of the major macro factors, we definitely have to have a lot more details on these policy aspects. And it's a tug of war there between aspects that can be good for growth or aspects that can be a little bit more concerning around inflation and margins.
I mean, you're not the only one, obviously, thinking about what this level of uncertainty is bringing not only, business leaders, but investors. I want you to listen to, both of you, listen to Ken Griffin today, who talked about this down at the FII summit down in Miami. Listen.
It's a very difficult time to invest because of the policy uncertainty that goes with this transformation. Mm-hmm. And one of the most difficult areas that we're all trying to navigate is not just the status of tariffs around the world, but who will be an important ally to America going forward, and with whom are we breaking down long-standing relationships?
That's Citadel's Ken Griffin, of course, down in Miami. The point being, second time in 2 weeks that he has used a forum to make that case. High level of uncertainty and very, very difficult to invest in it. You share that view?
Well, I think it all depends on your time horizon. If you've got a long time horizon, I think it's important to be well diversified and to a certain extent put on binders, because I do think it's going to be a bumpy road. There's going to be significant volatility because there is uncertainty. We just don't know who the winners and losers are going to be because there is so much in terms of unknowns with policy. I mean, we walked into this year thinking that we were going to have some positives for growth in terms of both deregulation and ultimately tax cuts, but that would take a little longer, and that we would have some risks presented by both tariffs and if we were to get some sort of extreme immigration policy with a lot of deportations. Those still exist, but there are a lot of unknowns around exactly how, what the depth and breadth of the policies will be, the execution. We've also added in there DOGE. Because that could create significant headwinds for the economy in terms of a cut in government spending and a lot of layoffs that could contribute to an economy where job growth has slowed, as Jay Powell pointed out last month in the FOMC press conference.
But you seem to be suggesting to tune out or ignore a lot of the noise and focus on the long game.
If you have a long time horizon, I think that's what's important to do.
But I mean, Ken Griffin's not investing for the next 5 minutes. Right. The problem is if you're a CEO and you're trying to invest for the next 3, 5, or however many years, the policy uncertainty makes that a little more difficult. We came into this year thinking that it was going to be almost a layup. Market's going to go up. Economy's going to be good. Animal spirits are going to take over. You're going to have more M&A. What if you just don't get that?
Well, again, I harken back to diversification. There are opportunities around the world in a lot of places. So to have an allocation to the U.S., but also ensure that you're not underweight areas like European equities, UK equities, Japanese equities, Chinese equities, some of the other EMs. Again, we just don't know exactly how these policies play out. But we do know that over the long run, being well diversified and having adequate exposure to equities is typically a good thing.
This is now the in vogue trade, the part of the conversation. It's like, no one wanted to touch China, which was the third rail of the investing landscape. Europe was a mess, cheap for a reason. Economy's in decline, going into recession. Their central banks, sure, were going to be more aggressive in cutting before we were. But now everybody's talking about, well, there's better bang for your buck elsewhere.
I think it's what we've really been seeing over the last month is if you're a bit unsure about the direction, valuations become very important. And this involves not just the direction of policy and the general macro backdrop, but also around the AI winners. right after the DeepSeek news. And so I think this is where the rest of the world comes in. If you take a look at Europe, for example, coming into this year, there was a 40% discount between Europe and the US. The normal discount is 15%. And this was true in every single sector in Europe versus the US.
For a reason, right?
And then the question is there a reason for the discount to be that large? Or is something improving at the margin cyclically? It does seem like it is. There's a little bit of an improvement in manufacturing, in sentiment, in household actual consumption in Europe. But then there's a much bigger question, and this is where we're not fully settled yet, is if structurally something is changing in Europe around fiscal spending, around more joint debt issuance in a way that's a true game changer. And that we'll see this weekend with the German elections, and then perhaps related to some of the issues around the war in Ukraine as well as tariffs.
What if there are structural changes currently underway in our relationship with Europe and the rest of the world? They're not cyclical, they become structural. Is that a problem for the market?
I think the question is how Europe responds. Does it seize the moment to join together and fix some of those structural issues that it has around low spending, low confidence, a lot of regulation, low innovation, low productivity, or not? And this is where, for example, some of the discussion around reciprocal tariffs might be a useful tool for Europe to get together and think about lowering trade barriers, lowering regulations. These are some of the things that are being discussed, and that could be a pretty big game changer. The other one is around defense spending and having joint debt issuance to boost spending.